Today's pick number one is WW. WW International Incorporated provides weight management services. Its products and services include nutritional, activity, behavioral, and lifestyle tools and approaches. It operates mainly in North America, continental Europe, the United Kingdom, and other regions. Originally known as Weight Watchers International Incorporated, the company is headquartered in New York. WW International is part of the leisure and recreation services industry, ranking 136 out of 252, according to Zacks Investment Research. Currently, WW International faces a challenging market environment. This is shown by its stock price, which has dropped significantly. Over the past 3 years, the company has seen a 92% decrease in value, highlighting its need for a strong turnaround. The departure of Oprah Winfrey from the board and her association with weight loss drugs have posed additional challenges, emphasizing the company's need to update its weight loss management strategies beyond traditional methods. WW International's effort to include prescription medication in its weight loss solutions marks a strategic shift, aiming to address both the biological and behavioral aspects of weight loss. Despite these changes, the company's future appears uncertain, with recent earnings not meeting expectations and struggles to maintain positive cash flow. Oprah Winfrey's choice to not seek re-election on WW's board to prevent a conflict of interest with her use of the weight loss drug Ozempic highlights the challenges WW faces in updating its approach in a fast-evolving market. Reasons WW International stock might be considered oversold include a strategic shift towards medication integration. WW is trying to update its approach by including prescription medications like Ozempic, which addresses the biological side of weight loss. This change may not yet be fully recognized by the market. Oprah Winfrey's departure. Oprah left the board to avoid a conflict of interest with her use of Ozempic, a competing weight loss product. Though well-intentioned, this move might have led to an overreaction in the market. This is considering Oprah's gradually reduced involvement and the potential for WW to stabilize and expand its core and clinical offerings. Market misinterpretation. The significant decline in stock price and negative outlook on WW's future may not completely reflect the company's efforts to rejuvenate its brand and adopt new weight loss methods. Despite facing several obstacles, WW International's dedication to a comprehensive weight loss strategy that includes both behavioral and biological treatments could set the stage for a recovery. Yet, whether the company will succeed in this new direction is still uncertain. Today's pick number 2 is SMMT. Summit Therapeutics is now in the business of developing drugs for oncology, with a current focus on treatments for non-small cell lung cancer and exploring opportunities in other solid tumors. The company's headquarters are in Abingdon, in the United Kingdom. In the world of medical drug companies, Summit Therapeutics is part of an industry that ranks 98 out of 252, according to Zacks Investment Research. Recently, Summit Therapeutics has seen its stock price go up and down quite a bit. In the latest trading sessions, the stock dropped by 11.79%. Looking at the company's finances can give us some clues as to why the stock might be seen as oversold. When we dive into the numbers, the situation appears tough. Summit reported yearly sales of $700,000, which is small compared to a net loss of around $614.93 million. The pre-tax margin is an incredibly negative 271,685%. Both return on equity and return on assets are deeply in the red, at negative 87.45% and negative 41.17% respectively. These stats show the company's financial difficulties, including a high debt-to-equity ratio of 1.29. However, it does have a strong current and quick ratio, suggesting it can cover short-term liabilities. Looking at how the market values the company, the numbers are also concerning. The price-to-sales ratio is 3,638.82, and the price-to-book value is 33. This suggests investors are cautious about the stock's value versus its financial results and assets. It's also important to mention the company's recent actions and developments. For instance, big investors like the Vanguard Group Inc., Goldman Sachs Group Inc., and Virtue Financial LLC have bought shares, possibly seeing some promise in the long term. Plus, the stock has increased from its value at the start of 2024, showing it can be a volatile but possibly beneficial investment for those ready to face the risks. Given all this, the recent selling of the stock, making it seem oversold, could be more about investors reacting to the company's financial state and overall market trends rather than a clear judgment of its future success. Today's pick number 3 is MEI. Methode Electronics Incorporated stands as a worldwide leader in the creation of electronic components and subsystems. With its designs, the company produces and sells devices that make use of electrical, electronic, wireless, sensing, and optical technologies. You can find Methode's components across various key sectors like automotive, appliances, communications, aerospace, rail, and other transport industries, as well as in consumer and industrial equipment. Methode Electronics within the electronics connectors industry, which is ranked 91 out of 252 industries by Zacks Investment Research. Lately, Methode Electronics Incorporated MEI has hit a rough patch, which has made some market watchers label its stock as oversold. Let's explore a few reasons why this might be the case. Firstly, there's been an earnings miss and net loss. Methode Electronics reported a net loss of $11.6 million, or 33 cents per diluted share, for the third quarter of fiscal year 2024. This outcome fell significantly short of expectations, missing the consensus estimate by 40 cents. Furthermore, the company's net sales for the quarter were $259.5 million, also below analyst predictions. Then, we've seen a decline in stock performance. The stock's price has plummeted by 45.7%, now hovering around $12.35. This is a sharp fall from its 52-week high of $46.58. Another concern is the negative net margins and low return on equity. The company's profitability struggles are evident, with a negative net margin of minus 5.09% and a very low return on equity of 0.07%. Despite these financial hurdles, Methode Electronics has decided to continue its dividend payments, declaring a quarterly dividend of 14 cents per share, payable on April 26, 2024. This decision could be seen as an effort to keep shareholders' confidence during difficult times. However, it also sparks debate over the company's resource distribution given its current financial situation. With these factors in mind, investors and analysts are keeping a keen eye on Methode Electronics. Currently, the stock holds a consensus rating of hold among analysts, indicating a cautious stance towards buying more shares or selling existing ones. In summary, the mix of missed earnings, a significant stock price drop, and financial challenges suggests Methode Electronics is navigating through tough times. While the dividend declaration might offer some relief to shareholders, the underlying financial and operational issues indicate a turbulent period ahead. Investors are encouraged to monitor the company's future earnings reports and management strategies closely. Today's pick number 4 is CABA. Cabaletta Bio is a company working on cutting-edge health solutions. They're in the business of creating specialized therapies aimed at autoimmune diseases. Their main projects include several innovative therapies that are currently undergoing tests. You'll find Cabaletta Bio's headquarters in Philadelphia, United States. Cabaletta Bio operates within the medical, biomedical, and genetics industry, ranked 71st out of 252 industries by Zacks Investment Research. But why do some believe Cabaletta Bio stock is oversold? Let's examine the recent developments and the general sentiment in the market to find out. Cabaletta Bio has been in the spotlight for its clinical advancements and strategic position in the biotech market. Despite a fall in its stock price, several indicators suggest the stock might be oversold. Firstly, FDA orphan drug designation for CABO 201, Cabaletta's treatment for systemic sclerosis, marks it as a significant potential solution for unmet medical needs. Secondly, the company's clinical trials, particularly its engineered T-cell therapies aimed at B-cell mediated autoimmune diseases, are showing promising progress. this progress may not be fully reflected in its current market value. Thirdly, Cabaletta's focus on autoimmune diseases places it in a specialized yet critical part of the biotech market. Its innovative approaches in T-cell therapy set the company up for substantial growth as it moves forward with its clinical programs. Lastly, an earnings miss for the fourth quarter of 2023 might have led to an overreaction from the market, obscuring the company's long-term prospects and recent successes in drug development. Cabaletta Bio's pioneering work in engineered T-cell therapies for autoimmune diseases, along with its recent regulatory achievements, indicate a gap between its current stock performance and its intrinsic value. This gap often suggests a stock could be oversold, offering a potential opportunity for investors who are keyed into the company's foundational progress and strategic direction in the fast-evolving biotech field. Today's pick number 5 is SHC. Sotera Health Company provides essential sterilization solutions, lab testing, and advisory services for the healthcare industry. It operates through its businesses, Sterigenics, Nordion, and Nelson Labs, and is based in Cleveland. In the medical services sector, Sotera Health is ranked 59 out of 252 industries, according to Zacks Investment Research. However, Sotera Health has encountered a challenging market environment, marked by developments suggesting the stock might be oversold. First, the company announced a secondary offering of 25 million shares at $14.75 each. This action, often seen as dilutive, can depress the stock price, especially if the offering price seems low compared to the stock's true value. Next, insider selling reports, including significant sales by the president of Sterigenics, may create negative sentiment, suggesting insiders lack confidence in the stock's short-term performance. Additionally, Sotera Health's fourth quarter earnings for 2023 fell short of analyst expectations, potentially eroding investor confidence. Despite revenue growth, this earnings miss underlines issues with profitability and operational efficiency. The company's earnings guidance for the fiscal year 2024 also disappointed some investors, potentially leading to a bearish outlook. This guidance influences market sentiment, especially if it's below the consensus. Lastly, the stock has seen unusually high trading volume and reached a new 12-month low, indicating increased investor uncertainty or a negative response to recent announcements and financial results. Together, these factors point to significant pressure on Sotera Health stock, suggesting it might be considered oversold. This situation could be seen as a lack of confidence in the company's near-term future, despite its crucial role in healthcare and sterilization services.